There's more silver in the ETFs than there is on the exchanges. It's the ETFs now that are the more driver of the price than the exchanges, because that's where more of the metal is.
Please join us for our next live stream Sunday, September 25th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, September 25th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Steve St Angelo joins us today. Steve started to invest in precious metals back in 2002, and later on in 2008, he began researching areas of the gold and silver market that, curiously, the majority of precious metals analyst community left unexplored. And these areas include how energy and the falling EROI, or energy returned on investment, stand to impact the mining industry, precious metals, paper assets, and the overall economy. And Steve considers studying the impacts of EROI, one of the most important areas or aspects of his energy research. And we're delighted to have Steve St Angelo join us once again today. It's time to saddle up and silver up for Steve St Angelo. Steve, welcome back to SBTV. How are you doing?
Oh, great, Patrick. Good to be here. It's been a while. A lot of things are happening, and we're still seeing issues with energy, so it's great to talk with you.
Great. Glad to have you back. And yeah, energy, we are definitely going to get on that topic. But first, I want to start off with the recent inflation numbers that came in. Came in at about 8.3%, slightly down from the previous 8.5%. Steve, are we beginning to turn the corner with inflation?
Well, that's a good question, because I think the market was expecting or forecasting even lower. And the energy did come lower. Actually, energy, I think it fell pretty good in the August CPI. What increased was food, vehicle sales, the medical part of the medical industry. It was higher, and as well as rents and homes. That's where the inflation was, and so energy did come down. But unfortunately, I still think we're going to see problems with food, because even though you can drive around less and you can buy less, people basically eat about the same amount of food, even though there's some waste. So I think there's going to be issues with the food security, food production. And so I think we're going to still see problems with food inflation. But now, as the Fed continues and the central banks continue to increase interest rates, and do their quantitative tightening, I do think over the next several months, quarters, we probably will see that inflation come down more. I don't know how much more, but I do believe that's the only way they can get it under control is by these policies. But I think we're going to have to wait and see what happens with oil, because even though we may get oil down to, who knows, the 60s, 70s, or 60s. The problem, the world needs to run at a certain amount, and we could see a nice pop in energy again in the winter or in the beginning of 2023.
Yeah, it's a great point, because a lot of people are suspecting that, as you mentioned, the inflation numbers did come down a bit, and a lot of it was because of energy. But again, a lot of it had to do with China and their lockdown. So 300 million people are under lockdown. That's almost the whole population of the U.S. And along with that, Biden, I believe he's going to shut off the spigot to the strategic petroleum reserve come November. So should these two things, really start to consume oil again, that will push up the price once again, and we may see inflation really move up once more.
Yeah, you bring up a good point, because looking at the amount of oil that has been sold out of the SPR, the average is about 5 million barrels a week. And so that's almost 1 million barrels a day. And some weeks it's been more than that. I think a week or so ago, it was more than 8 million barrels. And so that's more than 1 million barrels a day when you average it out per day. And I mean, that's like Saudi Arabia increasing its oil production 1 million barrels a day. And so when you add that into the market, and then you've got China, which they shut down I believe, Chengdu, which 21 million people. And so that consumes less energy. And so, yes, after the election cycle in the United States in November, that's probably when we're going to see the sales of the SPR stop. And I think Biden just announced they're going to start buying oil at 80. If they can you imagine buying oil and let's say taking 3 or 4 or 5 million barrels a week off the market, and with the added, China, if they get off of lockdown, yes, this could be we could see a huge correction and reversal in the oil price, and that's going to hurt. That's just going to hurt the inflation target by the central banks. And lastly, I think that would be also the floor in the metals, because the metals would probably start to. Oil is down today, $3 in the United States, and so we see gold and silver. But if that turns around, you'll probably see the metals turn around too.
Okay, yeah. Speaking of the floor of metals, I mean, I guess I'll just talk about silver for a bit here. We've seen it go back down to some 17 plus. Is that hopefully the floor for silver?
No, I don't think so. And I've been warning my subscribers. The number I look at, if I look at a long-term quarterly chart, is about 15, 15, 50. That would be a really good support level. It could go lower, but I mentioned that the primary silver miners, according to my analysis, Patrick, in quarter 2, it was about a $20 break even. All costs, not the all-in sustaining cost, not cash costs, all cost. So, and then you see the bullion banks, the commercials are now net long, even though there's this big short position. We can talk about that. So I think the thing is, even though we could see lower silver prices, I don't see it staying down there. I don't see it staying down there due to the setup that we're seeing in these other parts of the silver market, which we can also talk about later.
Okay, and I had looked at a few tweets, well, actually a bunch of your tweets. I follow you pretty close. You had talked about a silver, a short squeeze. Could you mind sharing a bit about that?
They call it the commercial net short position. This is the bullion banks, and this is my speculation. But when you have the cost of production at about $20, and we saw the price of silver during the Russian-Ukraine war, it shot up to like 28, right? 27, $28. Well, now at that point in time, the price, the profit margin, it's probably $7, $8 an ounce. And so as the price of silver goes up, the commercial net short position goes up because speculators come in, and the bullion banks have to hedge because they're the ones that get the silver from the miners. And so they're hedging. And so we see the commercial net short position increase as the silver price goes up. Then it peaks, and as the silver price comes down, the commercials liquidate their short positions, and it gets down to a low. And now, last week, the commercial net short position was actually long 5,000 contracts, when it's only happened 3 times in the last like 15 years. And the last time this happened, the price took off in the summer of 2019. I'm not saying it will. Now, but that tends to be the floor in the silver price when the commercials become net long, because they realize that they're buying from the miners, and the miners are now losing money. So why should they go short? And so the issue is the speculators, the managed money, have gone short, and they've gone short in a big way. I think they're 25,000 net short now. So, and then there's this huge short position on the SLV ETF, and they're borrowing shares. The cost to borrow shares on the SLV hit 6.4%. I mean, back in July, it was 0.2%. So there's this massive short interest on the SLV. The speculators, the managed money, is very short, but the bullion banks are net long. And who tends to win this battle? The commercials tend to win. Now, I'm not saying that the commercials can't become even more net long. They could actually add, they could go to 10,000 long positions or 15. That could happen and the silver price could fall. So this, when I say there could be a possible silver squeeze, it's because this is very extreme market. It's a very extreme setup. You've got the commercials that are now net long. They don't think the silver price is going to go down that much lower. But the speculators do because they see what the Fed and central banks are going to do, and they have piled on. They've piled on because they believe the metal prices are going to fall with energy. So that could happen, and that would bring the silver price. But who knows what happens in the world, like we had the Russian-Ukraine war, or we just don't know. And if the silver price, if something happens over the weekend or whatever, and the price starts to go up, really starts to go up, then these shorts are gonna, this managed money is gonna have to cover. And when they buy back their shorts, they push the price up. You know this is a short squeeze. But here's the thing, I don't know which way it's gonna go. I have no idea. And because the market is so volatile, we saw negative oil prices back right during the pandemic shutdown. And so it could be very volatile. We don't really know. But I think with the commercials being net long, Patrick, even though we may get a sell-off, I do think the silver price will bottom and we'll start to see a move higher over the next several months and quarters.
If you're enjoying this interview with Steve St Angelo and I, please consider subscribing to our YouTube channel and let the algos know you'd like to see more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Okay, so with what you said here, how about the actual movement of physical silver? Are we seeing the vaults in COMEX starting to drain a bit?
Well, the traders, the ability to trade silver, the registered category, yes, it's falling. It's falling considerably. And also the silver on the LBMA is falling. Matter of fact, back in the early part of 2022, and even let's say 2022, it was over a billion ounces. And now it's down to only 915 million ounces. And what's interesting, before everything started really getting heated, in 2019, the LBMA had 1.1 billion ounces of silver. But the ETFs, like the iShares and these other ETFs out of London and in Europe, they only held 34% of that silver in the LBMA was in the ETFs. So there was 66% of the silver held in the LBMA was for other investments, trading, whatever. Now it's totally flipped. Of the 915 million ounces that's in the LBMA, a lot of it in the last 6 months has gone to China and elsewhere, Canada and India. A lot of it's gone to India. The ETFs now control about 64% of that silver in the LBMA. So when we had that big increase during the pandemic shutdown and before, and then during the Russian-Ukraine war, the ETFs were able to access that silver, Patrick, because it was in the LBMA. It just changed hands. Now, if we get another big spike or demand for silver by the institutions or high net worth investors or whoever, retail, where are they going to get that silver? Because a lot of it is now moving out of the LBMA, going to India because India sees a great bargain at these lower prices. I mean, India imported almost 56 million ounces of silver just in July. The total mine supply in the world is like 62 million a month. That goes to show you how much silver that India imported just in July. So we're seeing some very interesting dynamics physically behind the market. So I find it interesting that the managed money and the shorts are thinking the silver price is going to fall, but the physical market is saying something else. And so I think it's going to be interesting to see how this plays out, Patrick. We're going to see a big move either way.
I kind of heard someone say something about the mining supply for 1 year is less than what's in the vaults or something? So people should pull out whatever's in the vaults. The mining supply for 1 year wouldn't even cover it or something like that.
Yeah, due to uh, surging lease rates, and Keith Weiner Monetary Metals covers this, the silver lease rates have shot up. And then, according to this gentleman, Bob Coleman, who looks at the silver market, we were like in backwardation since for the last like 3-4 months, which explains why the silver is leaving the LBMA, and it's also leaving the registered category on the COMEX. And so traders that want to do arbitrage, it costs them so much more now to carry metal. So they're decarrying the metal. And we're seeing this metal leave now. And so when you figure there's 915 million ounces in the LBMA, but only about a third of that, let's say about 300 million ounces, somebody can get their hands on, because the other 2/3 is accounted for these ETFs, the iShares and the ETF securities and these other ETFs. That's where it's accounted for. And in the United States, there's eligible silver, but that's not silver that someone can buy right now. It's the registered, which is only 45 million ounces. So you add the 45 million and you add it to the 330 million. Yeah, you now we're talking less than 400 million ounces. And the mine supply in the world is a little more than 800 million ounces a year. So it's about half. And there's not much in the Shanghai. There's some in the Shanghai in China that's reported. And so, yeah, you're correct. This available silver for traders is now about half of the world's mine supply, where back in 2019, it was probably more than global mine supply. It was probably 900 million or more.
You had mentioned something about the traders are seeing one thing, and then the actual physical silver market is seeing something else. Are we looking at perhaps the beginning of some sort of an event where the actual silver price may start to bifurcate?
You see, because of my energy analysis, that's the outcome that's going to happen, right? That's my analysis, because the energy is really going to hurt the values of stocks, bonds, and real estate. And as institutions, wise investors get this, they're going to move into the metals to protect their wealth, because you really can't do it in those assets. And so right now, due to the problems we're seeing in the world, due to these big problems with energy, and now in China, oh my gosh, the problems with their real estate market and the debt. So I don't know if we're starting to see this silver is now leaving these exchanges, the LBMA, and it's going into strong hands. Yes, this could be the beginning of it, but we'll know, especially if we do see the silver price start to go back up, and we get this correction, the price starts to go up, and these shorts, it becomes a short squeeze, and more metal is moving out of the LBMA and et cetera. I think that would be a telltale sign. And if you can hear the siren in the background, that just goes to show you there's going to be some red flashing lights ahead. And to me, Patrick, if it doesn't happen this quarter or next quarter, as time goes by, that situation, it's a guarantee to happen. And that's due to the problems with energy negatively impacting the value of most asset values. So it's a given. I just don't know the timing.
Yeah, because I think it's pretty interesting when you kind of take a step back and look at it. The silver paper trading price, maybe we call that the spot price. It's going to be one number, but people are already seeing the actual physical silver price is a completely different number.
The right now, the market, there's two markets. There's the institutional market, and then there's the retail bullion market. The institutional market has been the driver of the price. And I'm sorry we're having all these
It's
sirens
okay.
go by. But no, the institutional market is the driver of the price. And right now, I've mentioned this in many interviews, that when institutions are interested in buying gold and silver and high net worth investors and even retail, they move into the GLD, the ETFs, and even the SLV, and the metal flows in, the shares go up, and the price goes up. As they exit the GLD and the IAU, gold IAU, and the SLV and these other ETFs, the price comes down. It doesn't matter how much demand there is for bullion product. It's that market that's the driver of the price, and it has been. And we're continuing to see metal flow out, especially of the gold ETFs. And do you know why it's different now? There's more silver in the ETFs than there is on the exchanges. So it's the ETFs now that are the more driver of the price than the exchanges, because that's where more of the metal is. And so we're seeing it also, in the ETFs and the gold. It's not there yet, but this is the issue we're seeing. It's the flows of metal in and out of these ETFs and the exchanges that drives the price, not the retail bullion market. But I say in time that will become more of a driver as more institutions, more investors actually get and take delivery of physical metal. I think we're going to see that that's going to increase as time goes on, instead of these institutions and investors going into ETFs where there could be problems with these ETFs, ETNs, ETPs.
Steve, last time we spoke, we were talking about a China energy crisis and the line of trucks loaded with coal heading to China coming out of Mongolia, sort of like a coal train of trucks. Now, I know coal is needed for Chinese power plants and power generation, but can you give us an update on China's internal energy situation?
Well, they've had a lot of problems in China because they built this metropolis that devours a massive amount of energy. We had droughts, right? We got droughts in Europe, droughts in the United States, droughts in different parts of the world. China, huge drought. Matter of fact, the Yangtze River is one of the lowest levels since they recorded it and since 1865. And that's where they get a lot of their hydroelectric, and they transport coal and things up and down the Yangtze. The issue is, one thing they've done is they've added a Mongolian to China. They've actually just completed a rail, and they're delivering coal from Mongolia to China. But a lot of this coal is more for steel making. It's not the quality of coal the lower quality that runs in their coal-fired electric plants. The issue is, China is probably going to hit a record coal production this year, Patrick. It's going to be 4.5 billion tons of coal. And so this is the massive amount of coal that they have to burn to generate the power to run not only their residential, the electricity for the residential consumers, their industry. And so this is very problematic. And I talk about a collapse of the Chinese economy. And the thing is that's going to take time. But yes, this is an issue. They're still having major problems with power. And that's why I still think they're doing shutdowns, because that major city they shut down, they were having huge issues with power generation. A lot of it due to the drought, and this is going to become more problematic too. We're going to see more climate volatility on top of the energy problems.
Externally, we are seeing reports from traders that China is actually exporting LNG, which would support the notion that China has excess LNG, or liquid natural gas. Speculation is China is taking on more LNG from Russia, bypassing sanctions perhaps, and then selling LNG, albeit at a higher price, to Europe. Is there any truth to this?
The truth is, I'm reading the same information you are. And according to some articles like oilprice.com, and they've interviewed some of these traders and some of these energy firms out of China. I think China's Jovo Group, it's a big LNG trader. They disclosed that they have resold LNG cargo to European buyers. And then there's a future trader on Shanghai said the reason why they're doing this in China is because they can make tens of millions or $100 million just on reselling one LNG cargo to Europe. And so Sinopec, which is the largest refiner in China, during a conference call, they said they have been channeling a lot of LNG to Europe. And so, yes, I think the slowdown in China due to this huge problem they're having in the real estate market and the shutting down of many of their cities due to COVID, they have less demand right now. And so what do you do if you're an energy trader or energy company? You buy low and sell high. And right now, Patrick, even though the LNG, or let's say the gas price, the Dutch gas price in Europe has come down significantly. It was $100 at one time. That was the peak last month. It hit $100. Now, the United States, we're doing $9. But guess what? It's now down to 60. It's still 8 times above the 5-year average. If we go 5 years ago, the 5-year average was about $8. And now they're still 8 times above that. And so this is destroying the European economy. And even though they're off the peak, they're still paying 8 times what they did before.
Yeah, I mean, Steve, Europe is heading into winter. How do you think Europe is going to get through winter as a whole?
Well, I think the worst case scenario has been bypassed because they've imported so much LNG from different places, and so we have seen that Europe. I think Europe is now about 84% full. Their natural gas inventories. Germany is like 88%. But if you go back to 2019, which was a regular year, I think Germany was like 98, 95 or 96% full, and Europe was 93% full. So they were. I think the problem is they're paying such a high amount for this natural gas that's really killing them. So they're shutting. I mean, Germany is shutting down partially 3 of their steel plants, and Spain is mothballed one of its steel plants. And so even though they're going to make it through, they're cannibalizing their economy to make it through the winter. Now, who knows what's going to happen? Well, we're seeing an escalation in the Russian-Ukraine war. They just had this offensive. And from what I understand, there are British and U.S. mercenaries there. And so this might escalate now that Russia sees this. And with more sanctions that the NATO and Europe are putting, I think they've got their 8th round of sanctions. They tried price caps. That didn't work. It could get to where it could be very explosive in the winter. It depends how cold the winter is going to be, Patrick. But even if Europe makes it through, these high prices are destroying that economy. The German, they are the high-tech manufacturer in the world. They produce really good high-tech goods. It is destroying this economy. So we're going to have to wait and see. If we continue to see high prices, I think they're going to go into a recession and maybe even a depression in the next several quarters.
Okay, and for the green energy that Europe has plans for, should they be perhaps looking at nuclear?
They are. They're some of the ones that they were going to shut down, are the ones they recently mothballed. They brought them back online because it's dependable, right? It's dependable. Now the idea that they're going to add nuclear, no, I don't see that. There's several people think that we're going to go to nuclear to solve these energy issues. No, it's not going to happen. It's not going to happen. And even though China is adding nuclear, they are falling well behind their forecast, and they're getting huge price increases, and they're falling well behind what their forecasts were of bringing new nuclear power plants, because they're dealing with the same issues we are, or the West is. And so, no, nuclear is not going to be the answer for Europe. It may help. If they can add some of the nuclear plants they were going to shut down, if they keep them online, that can help. But nuclear is not going to be a solution. No, it isn't. Not for the world. Unfortunately, it's not.
All right, Steve St Angelo, we chewed on a on a quite a lot this interview. Uh, Steve, before we wrap up, can you let the viewers know how they can follow you and more of your work?
Thanks, Patrick. Yeah, I'm on Twitter. If you go to the SRS Rock, we've put in SRSRocco Report on Twitter. That's where I do a lot of tweets there, try to update some of the things. And then I've got a subscription service at the SRSRocco Report where I put a lot of details. I work 50, 60 hours a week putting out these details of how the energy is changing and how that's impacting everything. And then I've mentioned this before. The reason I'm such a big believer in precious metals, because our economy is nothing but burning energy to produce goods and services. Without the energy, there's no goods and services. And this has been the way of the world for thousands of years. Back during the Roman Empire, the late Bronze Age, the Middle Ages, it was cutting wood, making charcoal, smelting to make all the metals, especially iron. And so it was always energy that was the driver of the economy. And the precious metals are money because they store this energy value. And some people say they store energy. They don't. They're not a battery. They store the energy value. And unfortunately, fiat currency does not store energy value. It's a claim on future energy. And so are most of the stocks, bonds, and real estate. They do not store energy value. They're claims on future energy consumption. And if we get into trouble with energy, those assets are going to get into serious trouble. So I repeat that over and over again, Patrick, because it's important to understand that dynamic. So thank you very much for your time.
Thank you also, Steve. We chewed on quite a bit, and I appreciate your time as well. Hope we can do this again soon, and we'll see how all of these things unfold.
Yes. Yeah. We should do a touch base again in maybe another 3, 4 months, 6 months.
All right, absolutely will do. All right, thanks again, Steve. Appreciate it. That was Steve St Angelo sharing his views on the economy, energy, and precious metals. For more of Steve's work, please visit his website, SRSRoccoReport.com. If you like this interview, please subscribe, share, and hit that bell to be notified when more interviews are on their way. Audio-only versions of this interview can be found on iTunes and Spotify.